Hello and welcome to the latest episode of Damien's Market Update, the show where I talk about what's been going on in investment markets and what to look out for in the weeks and months ahead. Now, if you find any of this video useful, please make sure you hit that like button if you're watching this on YouTube and subscribe to our channel. And of course, if you hear this as a podcast, make sure you leave us a 5-star review and you also subscribe to the podcast. Now, in the Money to Massive Sunday podcast, episode 398, I spoke about the importance of the US dollar index and how it can go a long way to explaining many of the market moves that we saw in 2022. Now, the US dollar index is a measure of the strength of the dollar against a basket of currencies. Now, in 2022, the US dollar index rallied strongly. It peaked in the autumn before tumbling into the year end. Now, the US dollar index hit a multi-decade high in the autumn of 2022, and it became a headwind for US equities. But when the dollar weakened, the US stock market rallied, and a strong dollar not only tends to hit US stocks, but also commodities, especially gold, as well as proving a headwind for Asian and emerging markets. In contrast, a strong dollar versus the Japanese yen tends to be positive for the Nikkei 225, while a weaker pound versus the stronger US dollar can provide some support for the FTSE 100. Now, I mentioned that because these were trends that we saw in 2022. Now, a change in the value of the US dollar index will not always immediately result in a textbook move in another asset's price, but with markets hanging on every word that central banks and every move that they make and the latest economic data, much of this has been reflected in the movements of the US dollar index. It's all wrapped up in it. That's why it's important to pay attention to it, and I've brought attention to it before in these shows. Now, in podcast episode 398, I explained how at the start of 2023 the US dollar index was attempting to break out of a downward sloping triangle that existed at the time. Now, on the downside of that was the 104 level, which was of particular importance. Go below there and the dollar weakness could have accelerated and bring about a change in the fortunes for most asset classes compared to what they experienced in most of 2022. But if at that point we had broken higher out of that triangle, then the potential dollar rally was on the cards. Now, it's worth you calling up a chart on your phone or desktop to see the movements of the US dollar index over the last year. You can do that by searching DXY. And for those of you watching this on YouTube, I've put the latest dollar index chart up on screen, and it's got some historical technical lines drawn on there to show the triangle that I've mentioned and what happened next. Now, it only looks at daily prices to keep things really simple. If you want to do this stuff properly, you have to go and use candles and look at hourly charts, for example, but this is sufficient to highlight the overall trends. Fast forward to today, and the dollar index did indeed break below that key 104 level, and the fall in the US dollar index led to a reversal, or at least a significant change in many of the main trends experienced during the first 9 months of 2022, when the dollar index powered to that multi-decade high that I've already mentioned. So emerging markets were among the winners, as were US equities, which in recent weeks retested the downtrend line, with the S&P 500 testing its downtrend line that went back to the start of 2022. The only difference this time is that the S&P 500 finally broke out of that downtrend at the 5th time of asking. It's taken it over a year to do so. We've also seen bond yields tumble, meaning that your bond funds in your portfolios would have rallied, and gold exploded higher. I mean, the price of gold rallied almost 5% in January before giving back some of those gains. But unsurprisingly, the FTSE 100 and the Nikkei 225 in Japan lagged. Both of those indices face headwinds when their domestic currencies strengthen against the US dollar. So when that US dollar index fell, it started to prove a headwind for them. So why has the US dollar continued to break down in 2023? Well, it's because that index still reflects a lot of the investing narratives driving markets. Firstly, the market is pricing in a Fed pivot, meaning lower US interest rates, and this is reflected by the weakening US dollar, a strong euro driven by a more hawkish European Central Bank, as well as China's economic reopening. These have all added downward pressure on the US dollar. There is also less investor fear out there and more greed that's driving market, and this has caused the dollar to weaken as well because investors have been shunning the dollar because the dollar is often seen as a haven asset in times of fear. If you look at the famous CNN Greed and Fear Index, it's now flashing extreme greed after flashing fear only a month ago. So the big question is, has the US dollar index got further to fall? The chart shown on screen for those watching on YouTube shows the US dollar index 50-day moving average line and the 200-day moving average line recently formed something called a death cross. Now, this is where the 50-day moving average crosses below the 200-day moving average. Now, this is supposedly an omen of further market weakness. So in this case, it's the dollar index weakness. And the last time this happened was back in July 2022. And it did, in fact, mark the beginning of a significant downturn for the US dollar. But these things you have to take with a bit of a pinch of salt because they aren't always reliable. But with the market consensus now seemingly for the US dollar to weaken further, it appears that many investors have finally gone all in and bet that inflation has peaked. Central banks will stop tightening, they will begin easing once again, and severe recession will be averted. Even on this side of the Atlantic, the FTSE 100 has finally hit a new all-time high after 5 years of trying, while European equities, as measured by the Stocks Europe 600 index, has rallied more than 20% from the autumn lows, marking actually the definition of a bull market. But if any one of the market narratives or assumptions, especially the Fed pivot, proves false, it could cause a shake-up in that US dollar index, which in turn could unravel recent market trends. In fact, in recent days, we've had a demonstration of the fragility of the rally when stronger than expected employment data in the US sparked concern that the Fed might have more room to raise rates in the fight against inflation without derailing the economy. Well, it sparked the dollar index to have a powerful rally, taking it from just above the 101 level to just below the key level of 104 and its 50-day moving average. Now, this is proving a level of resistance, and if the US dollar index can break above there and push on above 105, then we could see a reversal of the asset price moves we've seen so far in 2023, which could put the rally in US equities in particular under threat. If the US dollar index falls lower, then the bullish investors' bets might just pay off. But as I say, in the last week, when the US dollar index rallied, we saw equity markets, particularly in the US, start to give up some of their gains and some of the trends start to reverse. So if you found that useful in any way, please make sure you hit that like button, you subscribe to our channel, and be back here next month for my latest market update.